Good afternoon, Quasar Markets Live. You know, I've got my friend Michael Litt. Man, you are the Mr. Global Investment Strategist. And last time you and I talked, you said go to cash, run for the hills, go dig up something in your backyard, throw gold in the backyard, go take your dog, your wife, and your kids and run to the mountains. Okay, here we are, Michael. Talk to me.
Well, actually, I said go to as much cash as you can tolerate.
Right.
Get out of the mega cap stocks and stay with your value. Stay with the S&P 493, but go to as much cash as you can possibly tolerate. I think that was 5 weeks ago. In fact, my kids, they decided to go to 85% cash. I went to 50% cash. We bought some treasuries. We bought the Vanguard long duration treasury, which has helped a little bit. So that was how we positioned ourselves. A couple sovereign wealth funds, a few endowments and pension plans that I advise. Tough for them to move, but they put some hedges on. That one of the sovereign wealth funds in the Middle East did sell close to $100 billion of risk assets.
Oof. Okay.
Which was maybe 10-12% of what they have. When the markets move like this, what I like to do is focus on fundamentals. A lot of people start staring at the screen, staring at the market, the indexes. It's a mistake. Let's talk about a couple things. And I know we're going to be, on more of a shorter tempo now for the next couple of months in our discussions. NFIB, Small Business Uncertainty Index. Had been improving since interest rate cuts started, but now it's reversed and it's reached 105, and that's a high level. That means that there's uncertainty among small businesses in the country, and that's reflected in the fact that revolving credit to businesses actually turned negative. Okay, now that revolving credit is normally used for stocking inventories and for expansion. So it tells you a lot about their intentions. Keep in mind, Stephen, 17.5% of the people in the workforce work for S&P 500 companies in this country. 82.5% work for small businesses. Small businesses are the engine that drive this economy, not the big ones when we stare at the S&P 500 index. What I'm seeing was an economy that came in, and I kept telling you last year, the economy is still strong, the economy is still strong. We came into this year with a strong economy. What we're starting to see is weakness in the economy. Okay.
Weakness where though? I mean,
with small business intentions in terms of their inventory build, there's a hesitancy. You're starting to see it now. We saw this.
When you say hesitancy, are you saying it as in a way that, okay, they're not buying any more to restock the shelves completely, or they're not buying as much?
Well, when it shrinks, the only time we've seen it, the last time we saw this shrinkage was during COVID.
Right.
And before that was GFC. It's a fairly significant marker. Now, I'm going to say to everyone that doesn't necessarily mean you're headed to a recession, right? Or it guarantees a bear market. And I'll tell you why. Because in 9/11, we saw it go negative in the fourth quarter of 2001. But then it recovered quickly, and we did not have a recession, okay? We need to keep our eyes on that. If it continues to retract, then you're going to get a recession. Now, what the market's doing right now is, and we'll talk about this in a second, it's pricing in what it believes earnings are going to be, right? Mm-hmm. It's in a correction. I think we just reached a corrective, official correction level, right? At 50, whatever we're at 50, we're down 10%.
Down 10%, yeah. Mm-hmm,
right? But it's what the market believes earnings will to be. If this continues to retract, those earnings are not going to be correct. They're going to have to be revised downward. And that's the first time we've said that in 4.5 years.
It's true.
Okay, so we don't know that yet, but we now are seeing the signs. So that's fundamentals that I want to focus on. Next thing is that retail investor bearish sentiment, right? It reached 60%. It's interesting. The 2 weeks after the election, it was extremely low, very bullish. bearishness was only 27 to 28% amongst retail investors after the election.
Okay, so what's changed?
At the inauguration, it was 29%. Extremely bullish. What's changed is that that's what we should cover in over time. But what's changed is that we have a disruption in our relationship with Europe, the European economy, our relationship with the European economy, economic bloc, which is about the same size as the U.S. Broadly speaking, the entire EU is about the same size as the U.S. bloc. We have perhaps made them question buying U.S. military goods, U.S. goods, U.S. As a trade partner. We may have done one of the worst trades in the history of the world.
What's that?
We traded
What's
a $30 trillion European bloc as a economic partner for a $1.4 trillion Russia. Right?
Right.
That's a reality. You may see something like boycotts of U.S. made products, U.S. brands by the summertime in countries like Canada, Australia, Mexico, and across Europe. That may be something in our future.
I mean, aren't we already seeing that where Ontario's premier is already pulling off U.S. liquor off the shelves? You're seeing that already, right?
Social media works both ways, Stephen. If some people believe, the rank and file go to social media to cut the U.S. off for what it perceives, then you could end up with something akin to what I just described. You also have the markets are a discounting agent of the future, what they believe the future will be. You have a increasingly greater uncertainty about the independence of the Fed, and I have stressed this in every call. If we go back to an Arthur Burns White House managed puppet Fed, then confidence in the dollar, confidence in our ability to manage inflation, confidence in owning U.S. assets, which has been, since the Arthur Burns Fed and since Volcker changed all this, has been a boon to the U.S. because we've attracted enormous amounts of capital, investment capital that has driven our economy. This is what is happening, Stephen. These are very big structural considerations.
Okay, so it's easy to say things are going bad. It's easy to say that the world's going to hell in a handbasket. What do you want to see change, and what do you want to see that would keep you back, put you back into the markets?
Well, I don't think that we're going to see a change here, Stephen. The market was at 24 times earnings.
Okay.
And that was an earnings based on a level of confidence that I think is going to deteriorate.
So you want to see confidence go back up, is that right?
Well, you need to have trade partners that have trust the United States. You need to have small business people. I went over to a roofing supply store today where they sell cedar shingles and all kinds of specialty lumber. And I was talking to the trades guys there because I wanted to get a feel for something. They're running out of the cedar shingles from British Columbia. The next stock that comes in is going to be twice the price. The guys, the trades guys, the small businessmen are going to have to go rebid. And I said, what percentage of the project is materials cost? And they said about half to 60%. I've got to go raise my prices 50 to 60% to the customers I quoted.
And is that where the customer all the way down? Is that where they say no? I don't want.
Now you're going to get what I'll tell you. What's still holding up is the consumer. But remember, the consumer does have a reaction function to losing money in their Schwab account, their Vanguard account, their Merrill Lynch account, right? And I think Torsten Schlock's done a good job of pointing out at Apollo that consumption and the consumer confidence has leaned on this bull market we've been in since May of 2020. And that will you won't see that in consumer numbers till the second quarter, but that's out there now, right? That you're now down 10%. You've got Bitcoin down however much percent, it's down 25%. You're going to see a secondary reaction function from that. I'm saying that I'm setting the table here, Stephen. We'll keep covering this every other week, but I'm setting the table and putting the issues out in front of people you need to be conscious of. And I will tell you the most dangerous thing I see in people right now is, you know how they say talking your book?
Mm-hmm.
A trader will talk up his positions that he owns, or a money manager will talk up the stocks he's overweight. People are talking up their political book. That is a recipe for disaster. You're going to get your head severed from your body if you rely on that and expose your capital to risk without thinking about these fundamental issues. We may be oversold here based on that retail investment survey, but I do think we've switched from buying the dips to selling the rallies, Stephen.
Mm-hmm. Buy the dips, sell the rips, huh?
And somebody asked me, when will the market bottom? I said, you're going to force me to answer that question right now with the little information I have, October, November.
That makes me a little bit nervous. I mean, that's a rough summer. I mean, I think you've got, we talked about this earlier today on the other show, was that right now it's March Madness, summer doldrums. You're maybe right. It may be where people just kind of sit on their cash and just don't care about the market right now.
Well, and remember, you can earn. There's a preference for cash now, because remember, we talked about this, that we haven't had for 25 years. You haven't been able to earn this kind of money on cash, so people will be more willing to sit with cash. But more to the point, you're going to get a lot of fundamental and structural issues that are going to play out between now and Labor Day. And I don't think there's going to be a positive reversal.
What about it? What about if Powell comes out and says we're lowering rates today?
Again, I think that the inflation numbers and, I don't think this Fed wants to react to risk assets. I think the Fed wants to be very disciplined about sticking to its knitting, and inflation is kind of bumping along.
Yeah, but you say you don't want to go back to an Arthur Burns type Fed, but this is a very heavy-handed bully pulpit presidency, right? I mean, he's pretty much screamed and hollered about he wants the rates to come down, and he doesn't really care about rates are coming down because he's seeing other ways of doing it, right? Cutting the government, Doge, and things of that nature.
For another time, whether, again, I said last time, I saw a headline that the Doge cut $3.9 billion in spending, and I told you the U.S. government spends $3.9 billion in the time from when I began that sentence to when I finish it right now. It was a joke. It's a joke, right?
Okay. All right.
And I think there has to be a much bigger Greenspan type plan for dealing with the transfer payments for Social Security and Medicare. They are 83% of the deficit.
That's right.
And I said last time, you can lay off all the FAA workers and we can all ride the bus. That'll be great for productivity. And Delta Airlines came out yesterday and said bookings are falling fast. Now,
business.
There's another tell. We don't know the answer. I'm going to say this. I'm lining data points up. I'm not going to sit and stare at the screen. I'm looking for data to see if the earnings we believe are not right anymore.
So let's talk about that. What data are you looking for? What data are you actually, if I were to look in the markets, what data should I be pinpointing and saying, this is what I know the market's going to change because XYZ data?
The primary fundamental drivers that Barton Biggs, Byron Wien, and Steve Roach and I used to look at Morgan Stanley. It's the primary fundamental drivers and business behavioral intentions.
Okay.
Forward business behavioral intentions. And I just do not see conditions helping those factors improve. And I'm seeing them start to deteriorate. The consumer is the one thing that's been holding up this circus tent.
And what do you think is going to make the consumer just back off and go? I mean, you just said that consumer.
This market, this losing money. Somebody said to me yesterday, my 401k is now at 256k. So yeah, no, I think that's going to have an impact, and we're more dependent on equity market wealth in terms of incremental marginal consumption than we have been in the past, because we've been in a long bull market here for 4.5 years, right? So you're going to have a little higher sensitivity to that setting. Let's continue this, but I'm just telling you, I was very concerned about a market at 24 times earnings and mega caps at 40 to 50 times. I was very concerned about a repeat of the Nifty 50 in the 70s. I'm very concerned about an independent Fed. And now I'm getting more concerned about these other things I've brought.
And how long did those downturns last?
Average bear market historically is 9 months. A long bear market is 15 months. The reason I picked October, November, because it's 9 months. I just picked the middle of the distribution curve. There was nothing special about it. But I think by coming into summer, you could see some very ugly scenarios. Again, social media cuts both ways. Watch for this idea of boycotting U.S. business brands and products. That is in play here, Stephen, and nobody is thinking about any of that right now.
Michael Litt, advisor to sovereign wealth funds, the big guy himself, institutions. Hey, Michael, we'll see you in 2 weeks, and Stephen, I hope you're wrong.
I hope is not a strategy, Stephen.
That's right. That's my
data research is.
That's right. Data research is. Right. I love it. Michael, we'll see you in 2 weeks, man.